They had a test last night.
Hello, we're the University of Montana. I'm here today to talk about Hecla mining. So Hecla is a low-cost silver producer with operating mines in the United States, Canada, and Mexico. They're the #1 silver and #3 lead and zinc producer in the U.S. Hecla aims to create shareholder value through high organic growth projects such as the #4 shaft project at their Lucky Friday mine. Current M&A activity includes acquisitions of Rock Creek and Montanore. Hecla approaches operations through a three-pronged strategy of investing in long-life mines to profit from the uptick in metal prices, a strong understanding of geology to increase reserves, and a reduction in operating costs and risk. Here's a map of Hecla's currently active mines. Casa Berardi, located in Canada, is Hecla's only principal gold mine, and gold, as you can see in the chart here, makes up the greatest proportion of Hecla's revenue, despite primarily mining silver. Also, San Sebastian, an open pit surface mine located in Mexico, has remarkably low operating costs.
Thoughtful analysis has encouraged our team to issue a target price of $7.98 with a hold recommendation. This target price is up 34% from the price we quoted on January 16, 2017. We're inclined to issue this recommendation because of Hecla's increasing margins and growing reserves, but the difference between a buy and a hold was made by uncertainty in silver prices. Because of this single factor, we're not convinced that the financially rosy picture of Hecla will remain that way forever.
Silver has an unlikely risk of being replaced, and the company also has high barriers to entry. Large capital requirements are due when you start a mining company, so it's tough to get new competitors in the industry. However, companies like Fortuna start and grow rapidly. Fortuna started in 2005, and they've already acquired 2 mines. However, they are in foreign country, and the weakening peso and their weakening economies have allowed them to get traction for growth. Other ones include Tahoe Resources as well as Silver Standard. Tahoe does have a higher annual production as well as a higher average mine life, but their stock price is decreasing. As Silver Standard stock price increases, their annual production is lower than Hecla's as well as their average mine life being lower.
Despite some difficult times in 2014 and 15, Hecla has made a variety of operational improvements in the past year. The addition of the San Sebastian mine, as well as the increase in silver prices recently, has allowed the company to significantly increase its operating margin, free cash flow, ROA, and ROE. Hecla maintains a higher cash balance and has increased its cash cost per ounce. Hecla has access to a $100 million line of credit, which has increased its current liquidity position to $300 million in the past quarter. It's worthy to note that Hecla rarely draws on this line of credit. Hecla's revenues are very sensitive to changes in metal prices, particularly gold and silver, given that they make up the great majority of Hecla's revenues. All else constant, a $1 increase in the average realized price of silver results in a $12 million increase in Hecla's EBITDA. Likewise, a $20 increase in the price of gold results in a $4 million increase. Hecla's net debt to EBITDA has decreased to 1.4 over the past 12 months. Hecla aims to become an investment-grade company, and they're trying to accomplish this by better managing their debt.
So when valuing cyclical companies such as Hecla, many traditional methods of valuation, such as looking at earnings per share, PE ratios, generally don't work, and they give erroneous values, and that's because they generally will have long periods of negative growth followed by shorter periods of extremely positive growth, and this is definitely the case for Hecla. So in this situation, it's important to normalize earnings, and essentially we're just looking at long-run averages over many up and down cycles. So the first method we use is the correlation method with the price of silver. The 52-week average, or the 52-week correlation currently stands at 0.76, and we ran a simple regression line over the last 10 years, and we see that the correlation is in fact increasing, and that number sits at 0.81. The Short-run drops in correlation are due mainly to Hecla releasing earnings reports and a little bit of lag time between the two assets. But as you can see, the correlation picks up again rather quickly. It's important to note that this high level of correlation has persisted since Hecla went public in the mid-70s. And it's stayed high despite Hecla's change in CapEx, despite increases or decreases in revenue, income, and sales. So silver is definitely the driving factor in Hecla share price movement. For that reason, it's important that we look at these silver cycles. And on average, silver has a 2.2-year upcycle and then a 3.5-year down cycle. During the upcycle, silver will move up on average just over 200%, and Hecla will move up almost 500%. And on the down cycles, silver will fall about 54%, and Hecla will fall a staggering 73%. And if you look at the chart, you can see on the up and down movements, they move almost lockstep, but Hecla acts basically as a leveraged silver contract. For the discounted cash flow method, after we normalized the discounted cash flow, we see that for every dollar silver increases, Hecla's free cash flow increases by 3.7 million. We then discounted this against the WACC of 9.5%. And for our growth rate, we used the risk-free rate of 2.2% for the first year, and then the terminal growth rate at 3.6%. And when you're valuing a cyclical company, it's a good idea to use the risk-free rate as a baseline, but in reality, Hecla's growth is going to be much more extremely high or extremely low. Once we gathered all this data, we came up with 3 plausible scenarios for share price movement over the next 12 months. Our base scenario, which we weighted at 60%, was the share price ending up at 829. And the best case scenario, which we weighted at 10%, was 1248. And the worst case scenario, which we weighted at 30%, is 585. And once we combined all these weighted targets together, we came up with a 1-year target of $7.98.
Like any company, Hecla is exposed to a variety of different risks as they operate in a relatively uncertain environment. Consequently, we've categorized their risks into market risk, operational risk, and regulatory and political risk. For most mining companies, their largest risk is their sensitivity to movements in interest rates and movements in metals prices. Except for a little bit of hedging, Hecla is fully exposed to changes in metals prices, making it difficult to deliver solid profits in times when prices are down. Interestingly, after the Federal Reserve hiked rates in 2015, this increased the sensitivity of metals to changes in the federal funds rate, as the graph here shows. Consequently, there's more downward pressure being put on the prices of metals. These additional interest rates are also making it more difficult to bear debt. Across the Pacific, Chinese industrial production has fallen dramatically, and this is depleting a large source of global silver demand. However, other South Asian companies are already stepping in to fill this gap. Hecla has had a history of net income volatility over the last few years, and unfortunately, years with poor performance are characterized by years with volatile share prices. Luckily, the company is positioned to deliver a strong earnings report for this last fourth quarter. Also, in a time where access to energy may be a large risk for mining companies to deal with, Hecla has taken great pains to deliver reliable and low-cost energy solutions, such as hydropower, to their mines. Finally, the withdrawal or renegotiation of the North American Free Trade Agreement under this new administration poses some risks for Hecla. 96% of Hecla sales are done to companies outside of the United States. Additionally, Hecla is lacking a permit for its Rock Creek mine, and it faces the proposed defeat of a $140 billion infrastructure package, which may be very helpful to them.
Hecla is a company with lots of room of growth and lots of strengths. However, outside risks do affect them. The uncertainty of silver is why we establish the hold. We do not establish a buy because we believe after the 1-year price of $7.98, we foresee a downturn in their stock price. And investors with this stock, we would advise them to either put options or stop losses on their accounts. Hecla is a strong company. However, the risks of a downturn here in 12 to 18 months is why we initially had a hold. Thank you.
Thank you.
Stand up, any questions?
I can take my first one. Great presentation, thank you so much. Quick question about your valuation. What silver and commodities prices were you using when you did the discounted cash flow?
We were using the silver's futures contract,
Okay,
SI/SI.
so you were holding a steady price throughout the
Yeah,
value?
we were using the continuous futures contract. We
Okay.
weren't looking at one expiration.
So how did you guys deal with, so it looked like the reserves have an 11-year life. How did you deal with their growth beyond that? I mean, what were your assumptions around future acquisitions or discoveries to, I guess, continue growing past that 11-year life cycle of their current assets?
The number 4 shaft at the Lucky Friday mine is expected to increase the mine life 30 years at Lucky Friday. And currently at San Sebastian, they're looking to increase that mine life as well. So most of their technological advancements, such as that shaft project, and then awaiting permit approval for the Rock Creek and Montanore mines, those have expected lives of over 30 years as well.
I asked a question of, I think it was back a couple of years ago that they had to shut their Lucky Friday mine down based on mine compliance issues. What's your guys' level of confidence in terms of their compliance with mine safety?
And that was a risk that we listed on our regulatory and political risk slide because you're right, there were a few compliance issues as well as and they've had some issues with employee injuries as well. However, we monitored, or I researched the progression of a lot of those talks, and there were usually settlements where actually, or there were a few settlements where the EPA or the DOJ actually never held Hecla to a monetary commitment at all for any of supposed compliance breaches. We factored those into our understanding of the investment risks, and we found also that Hecla has a commitment to really improving the safety of their mines and their compliance. They just actually won the Core Safety Award for the safety of their mines, and they've going forward they placed heavy emphasis on greater environmental compliance.
And going forward with the Trump administration, there's been a lot of talk about a relaxing of many regulations for mining and other energy industries. So we don't foresee the possibility of increased judgments negatively impacting Hecla in the future.
Isn't the primary regulator in that space though the self-industry regulating, where it's not outside government agencies, it's actually the gold and silver industry regulating themselves? Did you guys dig into that?
There's the institution that releases that mine safety award. I believe it's the National Mining Association is their name. I mean, obviously that Hecla is vulnerable to a lot of EPA regulations in particular, and occasionally when there's spouts with employee injuries, like any company, they're vulnerable to DOJ oversight as well. But particularly it's the National Mining Association that provides a lot of that oversight.
I have one more question. Going back to your WACC calculation, did you at all take into consideration like a country risk premium or any other type of, besides your, cost of equity, cost of debt? Like, did you look at it including anything else?
By a country risk premium, what do you mean by that specifically?
So like, how did you come up with your WACC in the sense of, so I know you used your cost of equity, all of that, but did you look at any other factors that could play into account how it would affect Hecla's cost of capital?
Well, from outside the U.S.
So like sometimes when you do a WACC calculation, you could look at, so say you had operations in Venezuela, right? So you would want to rate, give them a higher risk premium because it's more risky doing business there than say in Canada or in the U.S. Or you might want to give someone a little bit of a discount if they have, long life assets and good jurisdiction. So did you sort of take a look at any of those factors in comparing Hecla to their peers?
I did not, but the majority of their mines in Canada, that's pretty stable. And they only have one mine in Mexico, and currently it is producing a lot of revenue as far as its costs are concerned, but it's still a pretty small portion of the entire company. So at the moment, I don't foresee that being a big issue in terms of their WACC calculation.
Okay, and then one more follow-on question to that. Did you guys look at any qualitative factors that could play into your recommendation?
Such as?
Such as management team strength, there's a variety of things that.
Like corporate governance?
Yeah.
We did.
Mhm. Their board has a cycle of 2 years, so you're under reevaluation each 2 years, which is good because it kind of keeps you accountable. And if you're not doing your job as a board member well enough, like they can remove you from the board. Many of the board members have been on the board for a significant amount of time, but I view that as they're doing their job and they're doing it well, and they're adding value to the operations of Hecla and steering it in an appropriate direction. But they are each 2 years up for their seat again.
Do you guys look at M&A in the space over the last couple of years and whether or not the stock's trading at a discount or a premium to where different acquisitions have been done in the space over the last, say, 3 to 5 years?
I looked at that. We did a stock prices and news flow analysis, and most recently they acquired the Rock Creek and Montanore mines in Montana, and you actually noticed that as there were, at least every time Hecla acquired a new mine, there were occasionally there would be a brief jump in like immediately following the acquisition. However, the share price would return to normalcy following.
So they seem to have a pretty good track record of purchasing assets when the cycle's in a down cycle versus buying in up cycles.
That's correct.
Did you look at alternative methodologies to value them, such as looking at book value of assets? And
I did look at many of those, and the problem with Hecla is that they just have negative earnings for such a long period of time that many of the ratio analysis tools that you would normally use, just even when normalized, are predicting negative growth going forward. And a bunch of the ratios just were not kind of correlating or in line with what the company's growth as far as their they're just kind of cash flows was concerned.
So, but I guess my point would be with those negative earnings, if you were to look at asset valuation rather than a DCF model, like
The problem with the asset value is that when the asset value does increase dramatically when the silver price goes up, but then when the silver price crashes, they have to write down all those mines. They don't get to keep that high price. And so it's just kind of fluctuating all over the place. So trying to normalize that with a growth model, it just didn't seem as appropriate as looking at their free cash flow.
Okay. So another big investment trend on the institutional side is ESG, environmental, social governance issues. How would Hecla fit within ESG framework?
So the company, as we mentioned during our regulatory and political risk, they're subject to a lot of different regulations and a lot of oversight. But as far as their environmental and social governance, this is something that's stressed. This is something that the company did mention in their 2015 annual report that their Q3 report this year, I'm sorry, that they have attempted to create very, green mines. Like, for example, the use of hydropower has brought down their cost by 30%, and also it's a lot cheaper and more environmentally friendly than using diesel generators, which is what most of the rest of the industry still uses to power their mines. Additionally, as I mentioned, they won the National Mining Association's Core Safety Award, which is the top safety award in mining. So they're taking great pains to try to not only keep their workers safe, but also to make profits for shareholders in a compliant and responsible way.
And to speak to that, their mines are looking to build in Montana, Rock Creek, and Montanore. Montana as a state, very concerned with the environment. They're very concerned about the wildlife and then the land in general. And so those mines are going to be completely underground to preserve the environment as it is as well as they can.
How do you feel like their operations, and especially, I guess, capturing the gold and silver's value versus, how do their extraction costs maybe compare to industry? Are they more or less efficient than?
They're quite efficient compared to industry. But as far as that being reflected in their share price movement, it doesn't happen.
The company's had a 50% decline in in cash costs in the last year. Shows that they're
That's good. Thank you, guys. Appreciate it.
Thank you.
Thank you.
You guys take care of that?
Yeah, we'll take care of
Okay.
that for you guys.